You have heard of return stacking? It's a concept that's gaining traction in Canada and around the world in 2025, and it's a great way to add diversification to your portfolio. Think about how diversified you are right now, and then think about what could happen if you could diversify even further.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Rodrigo Gordillo. He's the president of Resolve Global, and he is also the co-founder and portfolio manager for Return Stacked ETF Suite. He brings nearly 2 decades of investment industry experience to the table. He specializes in developing innovative and diversified systematic investment strategies to a global clientele. His expertise has been focused on the advancement of return stacking, all-terrain portfolio construction, managed futures, and systematic global macro strategies. Rodrigo is the co-author of the book Adaptive Asset Allocation, which I have right here, and he can be heard on the Get Stacked Investment podcast. Rodrigo, welcome.
Thank you, John. It's a pleasure to be here.
We spoke a little over a year ago before we rebranded this podcast, and we were talking a lot about how global macro trends were affecting the investing universe and so forth. I wanted to bring you back on because your journey has taken you in a few different places, and I wanted to talk to you about what you're doing these days. So I want to begin by asking you what inspired your journey into systematic investing and portfolio construction.
Look, on the systematic side, I think we talked about this in the past. My background, like my father was a mathematician, right? He was a math professor at the University of Lima back in Peru. He was also the first man to bring a computer to the Peruvian Navy when he was a naval officer. And that led to my house when I was growing up in Lima in the 80s to have one of the first computers in LATAM, right? So that combination of computer programming and mathematics and 3 brothers that are very competitive, sitting down at a kitchen table and competing on math problems that my father gave to us was obviously a natural inclination towards quantitative versus fundamental style investing and thinking. And so when I ended up going and getting my degree at the University of Toronto in commerce and finance and statistics, it was a natural progression to say, okay, if I need to think about the world, how do I want to think about the world of investing? Do I want to think about it from a Warren Buffett, meet the manager style? Or do I want to identify patterns and really real fundamental reasons from a risk-based perspective as to why certain styles of investing quantitatively work and why they don't? And can I use that to my advantage? So that's the first thing. And then in terms of like systematic macro is because as a Peruvian that went through 7,000% inflation in 6 months in 1989, which led to us leaving Peru to go to Canada, then dumping all of our money into real estate right before a 50% housing crash, and then dumping all our family's money into tech right before a 75% crash in tech. What I wanted was a more resilient way of investing that can withstand or may even make money when things are going badly. And on the macro side, what does that really mean? I get to invest in not just equities, but I can invest in global bonds, global equities, global commodities, global currencies. And I don't have to just go long. I can go long and short. So you got this beautiful universe, diverse, broad, as liquid as you can get. And you combine it with unique quantitative signals. I fell in love and started working with that space.
Would there be a single pivotal moment that you can point to that shaped your career and your approach, or are you just a product of the upbringing that you've explained over the past few minutes?
My formative years are what shaped me investing like an 80-year-old, right? Like I'm in my 20s, everybody was doing new issue, getting on the stock bandwagon. That was like everybody at the time was 100% in commodities and wanting to ride that gravy train. And the whole time I'm like, what are you guys doing? You don't want to concentrate your risk like that. Let's diversify our bets across the globe, across asset classes, make sure we're risk balanced. And then we have a slight edge on momentum, mean reversion, relative value, seasonality that we can lean on. And over time, we make money. I don't need an 80% year and then a 50% crash. So it was my formative years that led me scared to do what everybody else was doing at the time, for sure.
So now you're talking a lot about the return stacking, and I'm wondering if you could maybe walk us through what that means and how it's a challenge to, let's call it, traditional portfolio construction.
Yeah, I think when you think about the traditional portfolio construction in the private wealth space, it of course has been focused around equities and bonds, mainly a 60-40 portfolio, right? And again, going back to my formative years, when I examined the returns of a 60-40 portfolio from 1900 to when I first started in the business, I saw a lot of lost decades that generally were a reality of too much equity risk during bear markets, and lost decades like the 30s to 40s, like the 60s to 70s, and so on, or periods of rising inflation shocks. And so that's again the 70s, the 40s were also a period where, 50s were also a period of inflation. And I just I couldn't wrap my mind around just being in those two asset classes because as an individual investor, depending on where you are, if you're a retiree, if you have a lost decade, whatever you thought you were going to be able to withdraw gets cut really quickly. And you needed to find a solution for that. And one of the solutions is to diversify a bit more. Maybe you buy some gold, maybe you buy a diversified commodity ETF. The problem with the diversified commodity ETF that does really well during inflation regimes like the 70s is that the rest of the time when there's no inflation, it's really tough to hold, right? And so the next answer was like, let's just make room, let's sell our equities and bonds and make room in our portfolios to add this kind of long, short, systematic macro that we briefly touched upon in order to zig when the equities and bonds zag. They tend to do really well in periods of bear markets. They tend to do really well in periods of inflation. And they also tend to do okay the rest of the time. Now, that's the operative word, okay, right? So when you're asking people to make room in their portfolios, to sell their favorite toys, their equities and bonds, and to add this diversifier, what they're actually implicitly thinking is that this diversifier is going to do just as well all of the time as your equities and bonds. And the reality is you have something that is different. Sometimes it zags when equities are zigging. And sometimes equities zig, 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 zig when they're zagging and zigging, zagging and zigging, doing something completely different that you can't understand. It becomes really difficult to hold those diversifiers. And so nobody does it, right? Everybody moved away from true diversifiers, and any alternative transition into privates, which are just more of the same risk, but they're just smoothed out from an accounting-based perspective. So the idea of return stacking is just a renaming an old idea that won the Nobel Prize back in the 80s. And it was invented in the 50s and 60s with William Sharpe. And basically what that was about was saying, look, you can keep your 60-40, but you can borrow some extra cash in order to be able to stack true diversifiers on top that hopefully have very low or zero correlation to your traditional portfolio. And even though you're using that leverage, you are reducing your portfolio risk because it's offsetting while making money over time, right? So it's the idea of like skis and bikes company, right? A ski company will make money at the end of the year, but will make all of it in the winter and lose a little bit in the summer, ultimately making money. And the bike company will make money in the summer and lose a little bit in the winter because they'll shut down, they have to pay rent and whatnot. But if you add it up, you make money on the ski company. But the best way to do it is to have a ski and bike company, right? So by stacking something similar that zigs and zags on top of your 60-40, what you're getting is the experience that most people want from a traditional portfolio, but you get this diversifier stacked on top that'll help reduce your maximum drawdowns, that'll provide you excess returns, even in periods where, let's say the 60-40 is annualizing at 10 and the systematic macro is annualizing at 3, not great. But when you're stacking it on top, you're getting an extra 3. You're not getting less return by making room in your portfolio. So the idea of return stacking was just keep it behaviorally easy for investors to add diversification.
Okay, so that's one of the things that I talk about all the time is being able to align your behavior with things that lead to positive outcomes, because a lot of people intellectually know what they should be doing, but they don't have the fortitude to stick with it to actually do what they know they should be doing. They know they should be doing it, but for whatever reason, they can't stick to their program. And finding things that are weakly or negatively correlated that zig when other things zag. And one of the things that, for instance, I want to talk to you in a moment about misconceptions, but one misconception that a lot of people aren't aware of is that you can make your portfolio less risky by adding something risky to it if it is zigging when the majority of your portfolio is zagging. And that's a bit counterintuitive, but a lot of people don't think about that. But what you're trying to do is you're trying to manage the glide path to keep it hopefully positive, but at the very least minimize the degree of the drawdown if there's going to be a drawdown so that you can stick with the program for all weather, for all circumstances and make it through. So that's one misconception. I wonder if you could maybe share one or two other misconceptions that people have about proper diversification.
Yeah, the idea that diversification is like, for example, one of the misconceptions of diversification that I see right now used a lot in private wealth is this adding private equity to your portfolio as a diversifier. And it feels like there's a lot of diversification there because 2022 happened, your equities went down 30%, they recovered, and private equity didn't do much. Now, eventually it plays out because private equity is merely buying companies, buying small cap companies most of the time. But because they're private, the only way to do an accounting of them and get a net asset value is by going to your accountant, and they're going to smooth out the returns. Basically private equity is an 18-month lag of the equity markets. And so they're able to smooth it out and it feels like diversity. But in reality, if we go through a lost decade, if we go through a period like the 70s or a period like the 2000s for equities, private equities will have a similar, if not worse, impact to your portfolio. And so I think the idea of the alternative sleeve having the same space with private equity as they do with liquid alternatives is the wrong way to think about it. So that's, I think, what's one key thing about the way people think about diversification. Smoothing out NAVs and having this phantom accounting is not one way. You really want things that zig when everything else zags. And
I think
then
the liquidity is an important consideration as well. One of the things that I
100%.
find is that there are a number of products that are perfectly fine in terms of being weakly or negatively correlated, and but oftentimes not all investors can get access to them. I don't have that problem in my practice because I'm a portfolio manager, so all the clients can get access by virtue of my being a PM. But there are lots of products that are good, maybe not fantastic, but good, defensible. But in practice, a lot of people need more liquidity and they can't get it. Whereas if you have a product that you can get out of in a typical T+2 sort of format, that of and by itself has value. It doesn't show up on a balance sheet, but it's worth something.
And I think the other thing that people miss about having a diversifier in their portfolio that isn't super intuitive, but people should understand, is that if you are able to find two things that make money over time, but move in different ways, and you rebalance into them, there's this concept called a rebalancing premium. Okay. And this is literally making returns out of thin air. It is this idea of like diversification is the only free lunch. The free lunch is this concept of having something that zigged, the other one zagging. You're selling some of the winner, giving it to the loser, while the loser mean reverts back to the mean. When you do that for a long enough period of time, we've seen results as like you can get as little as 1 extra percentage point by this rebalancing premium and as much as 3% in periods where things are really dispersed and diverse. And we wrote a ton on this concept a few years back, but it is when you're just taking on the same risk, when you're highly concentrated in equities, for example, or the Mag 7, and you think like, this is the way I'm going to make all my money, you are definitely taking a lot more risk. You're not using diversification to your favor, and you are leaving money on the table by not allowing that rebalancing premium to happen. And what also tends to happen is that when people have a diversifier that is zagging when the other thing is zigging, what they should do without thinking about it is rebalance. And what most people want to do is let the winners ride, not rebalance, and then sell their losers and leave it in the cash. Right. So there's always an aversion to rebalancing, and diversification is really the only way to capture that excess return. But you have to religiously and systematically rebalance all of your positions, whether you feel good about them or not.
And it's funny because in my practice, I've been doing a rebalancing in February to do some of what you're saying. And I've been pounding my fist on the table to a lot of people. We're now almost 2 months into the year. And a lot of people didn't want to rebalance because a lot of things went up in 2024. So they didn't want to sell and trigger a tax liability that they'd have to pay in April. Well, you've had whatever, pick it 60 days, let's say, by the time this episode airs, 60 days to rebalance the portfolio. What's taking you so long? You've got a chance to sell or trim some of your winners, to reposition some of that money into things that have done less well, and you don't pay taxes until April of 2026. But people, but the winners are running, so we want to let them keep on running. It's like, okay, well, what you're doing is you're taking more risk by dithering. You think you're being smart, but you have to do it, and that's one of the things I talk about as a behavioral hack that you have to think about. Like, not only do you know what you have to do, people know they have to rebalance, but they don't want to do it now. They wait until things start turning around. It's like, I should have rebalanced. Why didn't I? Yeah, well, that's my question. Why didn't you? You had the chance. Let's talk about trends. What are the things that are going on right now in 2025 that are maybe exciting you in terms of the way the industry is evolving?
Well, look, from a regulatory perspective, I think we're finally going to be able to invest the way we learned about it in our first chapter of our finance textbook or our CFA or our CIM,
Mhm.
where they teach you, look, you need diversification. And then you need to be able to have the option to create the optimal portfolio weightings, including all those diversifiers of gold
Right.
and systematic macro and equities and bonds, and then go up and down in terms of how much risk you want of that pro rata portfolio to be. If you want less risk, you add more cash to it. If you want more risk, you just use a little bit of leverage to expand the whole portfolio, the well diversified whole portfolio pro rata. And that's what won the Nobel Prize for William Sharpe. And that is not what we practice in private wealth. Institutions do it, CPP does it, Teachers Pension does it, but in the regulatory landscape we were in, they just didn't have room for it until recently. And there's been a few exemptions that we've been able to get in Canada and the United States that now allow us to really play at par with the large institutional players to help us actually stack returns on top of a traditional portfolio. That's my favorite theme, is that that's happening and everybody's talking about it. And there is going to be a new category created in Morningstar for it, I believe, in the next year or so. That's going to provide some clarity on that. But it really allows now, people think that investing like an institution is buying more private equity. No, the good institutions that are medium sized are using this concept of return stacking and making a lot of money. They feel like they're cheating by doing it, when in fact it's just what we should have been doing all this time. So
And
that's
it's
my
funny.
favorite thing, and I can talk about my second favorite thing, but I don't know
Oh,
if you got
okay,
some
so
more.
yeah, I was just going to add that it's as though it's a false dichotomy. We're saying you can either do these global macro return stacking sorts of strategies, or you can have private equity, as if you can't do both. And there's no reason why you can't
Totally,
do a little bit of each. And again,
totally.
a lot of the best institutions are in fact doing both. And all you're doing is finding other better ways to add to your diversification to smooth that path so that you can have the proper behavior. I'm going to ask you about behavior in a moment, but I think you were saying that you had another theme or trend that you wanted to talk about. So let's
Well,
let's
the
talk
the
about
other
that.
thing that may not feel like it's an important thing or a nice thing for me to say is that there's been a lot of macro changes and continue to be a lot of macro changes in the economy in the last few years, since COVID, really. Where the people had forgotten about the benefit of diversification. They've forgotten that when in 2022, when equities and bonds moved down together and lost the same amount of money, roughly, at the same time, like in most investors' mind, that couldn't happen. Bonds were my diversifier. What happened? We always knew what would happen academically if rates go up unexpectedly. We always knew that was going to cause equities and bonds to go down together. But we hadn't seen it since the 70s, and therefore diversification out the window. I think COVID and the Ukraine war and the inflation boom has really shifted the psyche for investors, where they say, I need better diversifiers than just bonds. And there I am waving my hand saying, I wrote the book about this 10 years ago, and I've been talking about this for 20 years, which is this is exactly why you need to have more diversifiers. And I think that sadly, we're going to continue to see inflation shocks happen to us until things settle down in a decade or so. And if that's the case, it's going to reframe wealth management for every investor to talk to their advisors and say, okay, what other protection can you offer me? What's out there? And then that's going to cause the advisors to look out and see, okay, well, what is the best diversifier out there for inflation, for bear markets? And what they're going to find is out of all the hedge fund categories, they're going to, whether it's market neutral, long, short, merger arb, all that, the ones that fit the bill for inflation and bear markets is going to be managed futures and systematic macro. both areas that I've always been passionate about for those reasons. So that's a trend that I'm really excited about, getting people to do the right thing.
Now, we've been talking a bit about behavior, and I'm wondering if there are things that you can talk about to overlay what you're talking about with the things that you're passionate about with decision making and investor behavior. What sorts of things should people be thinking about, and how can strategies such as a global macro strategy and return stacking help to improve the way you stick with your plan?
Well, one of the things that, as we alluded to earlier, that we find with every human being is it really is tough to invest in things you don't fully understand. Equities, people seem to understand why they're going up, why they're going down. It's in the news. We get it when there's a recession. We get it when there's inflation. Bonds, I think people are starting to understand how bonds work,
Yeah.
right? So certainly when there's no inflation, it's a nice little coupon. It grows when rates are going down, but when rates go up, they get hurt. So there's a clean understanding of those two assets. And I think that's why they're the most popular ones and the ones that we stick to. But there is a time now where investors are going to have to start getting comfortable with being uncomfortable. What do I mean by that? They're going to have to move out of their equity and bond comfort zone and start contemplating allocating to things that are going to make less sense to them. But if you look at the data, and if you really just look at how they've moved, you're going to want to own. I think gold is an asset class that people are going to need to own and should have always owned. And what's hilarious is that over the last 20 years, that's one of the best performing asset classes, beaten equities, right? And it shouldn't, but it is. And this is a hedge against currency debasement. So you have to understand gold's role in your portfolio. And then on the inflation and bear market side, you do have to understand, I think out of all the categories that are available to retail investors today, I do believe strongly that the next thing that they need to get comfortable being uncomfortable with are these long, short, managed futures and systematic macro funds, because they have, in my opinion, the best chance of being there for you when you need them the most. And you don't need to understand absolutely every single detail, but you need to understand their character, why they tend to be there for you when you need them, and then rebalance back into them. That is the behavioral part is going to be a bit of a lift. If you have it as a separate line item, it's always going to be tougher to hold. Luckily, with the new return stacked ETFs and mutual funds that we've launched, you can, it makes it a lot easier because we're mixing the systematic macro and the traditional equity and bond asset classes in one line item, which allows investors to kind of they're not seeing the feet of the duck underneath the water doing all the hard work. They're just seeing a nice little glide path of the allocation, the return stacked allocation that mixes all of those things together so you can see the all-in benefit of diversity. So it helps a little bit with being less, you don't have to be so uncomfortable. It's a little bit more comfortable. But regardless, it is an important time to think about what diversification means and why it's important in the next decade, if not more than that.
Very quickly, can you talk a little bit about mistakes and the mistakes that people make when they use alternative strategies?
Yeah, I think the mistakes that investors make is they often just say, okay, you suggested that. Okay, I trust you. Let's move on. And I think trust is important in a relationship, but trust vanishes when things are going wrong. And so I think the mistakes that are made by advisors and investors is they don't bring in they don't bring their knowledge up a little bit more to say, okay, I know what to expect here. I know to expect that these strategies over a prolonged multi-month bear market are going to be seeing trends to go long bonds if it's a non-inflationary bear market, go short equities and short commodities. Or if it's inflation, they're going to be long commodities and short bonds, right? Because they're falling into it. Understand a little bit about what the duck is doing under the water so that when, let's say, they buy it after the crash and they think, okay, I like this because it did so well. Well, they need to understand that the S&P or the TSX is likely to have this massive spike in positive volatility and outperformance and mean reversion that you don't see normally and drastically outperform something that is risk managed. That's when they give up, right? When they see that change. But you never know when that's going to flip. You want to understand it a little bit. The mistake is not understanding a little bit as to what the character of the thing you're investing in. And then you got to give it time, right? I think it's time to get knowledgeable And there's never been a time where you can gather more knowledge about this stuff than today. It's just a matter of going to Google or going to your ChatGPT and asking questions about return stacking and systematic macro, getting a bit more comfortable with it, and recognizing that there are some real solutions in Canada and the US now that they can finally tap.
Right. So let's end with the question that I always like to ask. This is a podcast called Make Better Wealth Decisions. What advice would you give to people to help them make better wealth decisions?
The first thing, and I think you will second me on this, forget about anything I just said. I'm a systematic guy. Okay. I think everybody should think systematically. If you're not putting away a amount of money automatically withdrawn from your bank account that goes into your investment account right now, you're making a massive mistake. The reason that people own houses and that ends up being most of their wealth is because they are forced to save every month. It really is incredible, the research that comes out of somebody that simply just puts in an automatic withdrawal and forgets that exists, how much wealthier they are 10, 15 years down the line. It may not seem like a lot if you put in $100 in every week or every month. Try to push the limit there. Ideally, you'd save at least 10% of your money. But that's the number one thing that I think investors need to do. And then the rest will take care of itself. You do that and you put it in a diversified portfolio, and then you don't like it. It literally has to be that black hole like it is in real estate when you pay your mortgage off. You don't know what's going on. You're just putting it in and you're not thinking about it. The same thing needs to happen with your portfolio. Do a systematic approach of saving, systematic approach of getting that reinvested, and then don't look at your portfolio until you retire. That is the best thing you could do. Just don't log in.
Okay, Rodrigo, thank you very much for your time today. It's been a pleasure as always. And I want to wish you all the best with the work that you're doing with Evolve. And we'll talk to you soon.
Thank you, John. Appreciate it.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.